Typically, securities market regulations ask firms to disclose more information to their investors because more information helps investors to make better investment decisions. In our research, we ask whether increased information disclosure to the investors might help firms to collude on their product prices and harm their consumers. What we show is that the governments, when they want to crack down on the cartels and the increased antitrust enforcement against explicit collusion, might necessarily achieve the full benefit of it because some of the firms will switch to sharing more information through the financial disclosure documents and thus collude tacitly. Explicit collusion would, for instance, involve two firms, the managers of two firms, meeting in a smoky hotel bar and agreeing on the product prices that they would charge their consumers in the next month or so. While implicit collusion will not have any direct communication between the managers or the representatives of two firms, but instead the firms will change their product pricing strategies based on the decisions of other firms. What we show is that with stronger antitrust enforcement, the firms are less likely to redact sensitive information like product prices from their material contract with customers that they submit to the Securities and Exchange Commission. And they're more likely to discuss the product market strategies in the conference calls with equity analysts. In one of the FTC cases, the firm making a conference call suggested that they will decrease product prices if their rival, who was listening to the call, will not keep the prices high. This information is unlikely to be helpful to investors, but helps to facilitate tacit collusion. The takeaway of our research is that there's an inherent conflict between securities market regulation that asks for more disclosure to investors and the antitrust regulation that generally wants to limit disclosure if they want to protect consumers.